You're watching us here on Chartbusters, and as we speak, all the frontline indices back in the green. The market opened in the red. Thereafter, there's been a stellar recovery. The mid-cap index, most notable of them, has risen to the high point of trade with a gain of almost 600 points right now. Way more stocks advancing than the number of stocks which are declining. I'm Mangalam Malu. With me, as always, Nigel.
Well, hi, Mangalam. And we pointed out on the Nifty bank that the 51,800 mark becomes crucial, and it bounced off that 51,850 odd mark. But plenty of companies came out with their set of numbers. So let's get straight to one of them. Rossari Biotech reported a record-breaking number in the first quarter, with the company delivering its best ever revenue, profit as well as EBITDA. To decode those numbers as well as the way ahead, we're joined by Mr. Sunil Chari, the co-founder and the managing director of the company. Hi, Mr. Chari. Good morning. Always good to have you on the show. Well, last year you grew by close to around 10%. This year the start has been quite good, and you're optimistic on the growth prospects. What can you guide us for in terms of a growth outlook for FY25, and also give us some color on exports? There have been some challenges with regard to the Red Sea, talks of slowdown globally as well. I think that's 25% of your mix. What was the growth in the past quarter, and are you seeing any kind of headwinds?
So we did about 24% of our sales in exports. We had some issues with the prices of the freights and the delays in our consignments reaching our customers. But we have taken that into stride, and I think we are confident of doing 25% of our sales as exports for the current financial year. The domestic market also is picking up. And in fact, our volumes in domestic market in the last quarter were higher than in the fourth quarter of the previous financial year. So we are happy that, on both the fronts, the domestic and the export front, our volumes are growing. The HDFC, which is our driver, it is now nearly 3/4 of our sales, which is at 75% of our sales. And the last 5 quarters, we are consistently growing, both in terms of top line and in terms of EBITDA as well. At 35 crores, we had the highest ever PAT in the history of Rossari Biotech Limited.
So, Mr. Chari, you're saying that exports will constitute around 25% of the mix. The consolidated growth will be what for the year?
At this moment, times are very uncertain, so I'm not able to, give you a number on what we will grow. But I think we should grow at a good speed this year.
Good speed. Would the first quarter numbers sustain into the next couple of quarters, or would it be, around these levels itself?
Yeah, I think we should be around these levels or higher. There is no possibility seen to go lower than these numbers.
All right, so at least 19%, and at higher levels you can see growth anywhere between 20 to 25% as well. And this at the same time you have a lot of capacity coming up in phases as well. I see the expansion on the Dahej facility. There is the commissioning for your ethoxylation capacity, etc. as well. So on what phases do these capacities come on board, and what does that do to your incremental revenue at peak? What is the potential here?
So the expansion will be completed by March of 2025. So the next year we should see the increase in our production and increase in sales due to the new expansion which is coming up. This depends on we getting ethylene oxide from plants, and we are expecting a good growth in next year because we put up good capacities for ethoxylation and surfactant manufacturing. Even at Rossari Biotech Limited, Dahej site, we have put up backward integration into some of our key raw materials for Unitop, and that should also show us in numbers in the next year.
So, if you could simplify this for us, what is the increase in your gross block going to be because of these phased capacity expansions, and as a result of which, what could the incremental revenue be? What are typically the asset turns in these plants that are coming up?
So as on 31st March 2024, our gross block was 415 crores. We think by March 2025, on a consolidated level, our gross block should increase by about 100 crores. And at a peak, we expect every rupee of money we invest in capex to give us 4x minimum in terms of sales.
So 400 crore in terms of incremental sales, that is likely to play out over FY26-27. That's correct?
Yes.
Okay, all right. What about animal health? Out there appears there is still some pressure. Revenues were down by 7% as well as 21%. What is leading to this? And when do we see growth come back to this segment? Which quarter?
So we are putting up a vitamin and a trace mineral premix plant at the Rossari Biotech site, I think, which should be also on an operational by end of this financial year, means March 2025. So the next year we should see uptick. There was overproduction in the poultry segment where we are present mostly, and we are very conscious, of not losing any money, debtors days. We never had any bad debt in the history of Rossari in the last 27 years. So we've been very conservative. We have maintained the same amount of volumes. Our profits are higher in AHN than in the past in the quarterly figures. So we feel that this segment has the highest growth potential in the years to come because the base sales are much less compared to other segments.
Right. Just finally, before we let you go, your institutional cleaning business, you had said earlier that this is a cash-consuming business in terms of both costs as well as working capital. And until it reaches a certain size and capacity, there will be a bit of a push in this business. So if you could tell us, one, how much does this contribute to your business right now? And at what level does it, become a lot better for you in terms of operations, etc.? What's the plan over the next 2 to 3 years here?
So the last year, the institutional chemicals business we call Rossari Professional now, which it was called Buzul Rossari earlier. And this we did about 150 crores. And this year, we are expecting that to become 250 crores. So it will be nearly a 60% growth over last year. This requires a lot of investment in terms of people to service, to audit, to maintain and train the workforces. We primarily deal in products which are for the cleaning, hygiene and disinfection segment. And this goes into airports, malls, hospitals, offices. And there is a lot of unskilled, staff and workers and with the facility management companies who are our primary customers. And we need to train and maintain. For example, if we go to a 5-star hotel, we need to check the microbiological load on the dishes we wash or, the linen we wash and help them wash at their sites. And because of this, the competition is not very big, but the competitor who is there with us in this segment is a leader for the last 40 years. And we are breaking new grounds everywhere, primarily because we are continuously investing in putting up people everywhere so that we are able to service it better always.
All right. Thanks a lot, Mr. Chari, for joining in. 250 crores from that business this year. But of course, you are investing out here. So maybe we'll see growth out there going forward as well. And maybe, your return ratios would improve once these assets sweat. While you were speaking, at the bottom of your screen, there were some flashes coming in on Garden Reach Shipbuilders. They've signed an MOU, and as a result of which the stock's seen a bit of a spike. It was anyway higher since morning and now has moved to the high point of trade. But we slip into a short break, and as we do that, let's tell you that we'll get you the best of market and micro voices ahead of the union budget. Tune into CNBC-TV18 at 9:05 a.m. onwards on budget day tomorrow. We'll be live from the National Stock Exchange with Morgan Stanley's Rhythm Desai. There's Nilesh Shah of Kotak AMC, Prashant Jain of 3P Investment Managers, and NSC MD and CEO Ashish Kumar Chauhan. So a star panel right from where the action begins, the National Stock Exchange budget opening bell, only on CNBC TV 18. Well, let's take note of Patanjali Foods. The company reported its numbers. There was a turnaround in the oil business, the edible oil business as well. The stock opened mildly lower. From there, it has seen a good recovery now at the high point of trade. And we have the management with us sitting with a gain of about 1%. Sanjeev Asthana, who's the CEO of the company, joins in to discuss the numbers in detail. Thanks a lot, Mr. Asthana, for joining in. The turnaround business, of course, was the edible oil business. So just a couple of details is what we want for this business for this year. What is the volume growth that you're targeting here? And as a result of which, margin target as well? And more importantly, how have the prices been in the first half of this year? How do you expect that to be in the second half? So price, volume and margin.
So overall volume, typically this is a low quarter sort of month that we have. So volumes actually have marginally declined. But this, our estimation is that the volume growth that we target typically between 6 to 8%. we are pretty much on course for that during the year. So the next quarter, the festive season picks up, the wedding season starts to pick up. So we will build up on that volume part. The price-wise, overall, the benefit that we clearly saw that the prices were very stable during the quarter, which has helped us sort of make reasonable margins in the edible oil business, which are more prone to volatility. And my estimation is that our guidance for between 2 and 4% margin in the edible oil business, we should be able to pretty much sort of stay within that range. And we will certainly try and do better than that. So, for example, this quarter we've done better than 4%. But overall, if we can stay at 4 and better, it'll be very good way of running around the business and growing that.
Okay, lovely, great. So we have got color on that. Tell us a little bit about the FMCG business. You had the expenditure because of the ads to IPL. So could you quantify what was the total amount? And next of that spend, which I am assuming is one-off in nature, what can margins look like?
So the margins, during the quarter, I mean, they've had a slight sort of tapering off, that we saw in the margin. Primarily, this was on account of very exceptional two events which happened. One was the excessive heat that we had, especially on the Indian specialty food segments like, Chyawanprash and ghee and honey, etc. That we expect will stabilize. And the second one was the inventory overhang of the previous quarter when we had a pretty exceptional sort of business that came in, which drove the prices, which allowed the inventory to build up, and there was not a sort of too much of evacuation. So this we believe is going to go forward, will stabilize, and our guidance pretty much that 11 to 12% on a blended basis for the overall FMCG segment, which is comprising of biscuits, the Indian ethnic foods, consumer staples, nutraceuticals, and Nutrela, the soya products, I think will be pretty much there.
11 to 12%. I remember you had earlier said that the food business steady state margin would be around 15 to 16%. And one would assume that with the home and personal care business coming in, the non-oil margins could be a lot higher. Why just 11 to 12%?
Oh, no. So I think I'm just, it's on a blended basis. So there are margins across the board. For example, our Nutrela margins are 16 to 18%. Nutraceutical margins are 25%. Our biscuits margins are about 12%, which are consistently showing remarkable growth. Our margins on the Indian sort of specialty, foods like Chyawanprash and ghee, etc., are, between 16 and 18%. The consumer staples category typically is around 4 to 5% margin businesses. And that tends to pull it down a little. But overall, with the expansion of the higher margin businesses, we should get pretty much in that category of 16 to 18%, which is what we've always projected. So if you carve out and take this out, about, typically, business run rate of about, on the consumer staples, then margin is pretty much in the 16, 18% profile. On a blended basis, I was saying that 12% is what we can, aim for on the overall FMCG portfolio. And with the HPC portfolio coming in, this should tend to get closer to 16% on an overall basis.
Final question, Mr. Asthana, before we let you go. Food business is around 30% of the mix. By when does it get to 50%? And by when do you complete the acquisition of this HPC business?
So the answer to that is that our stated strategic intent, which we declared last year itself, that we want to get it closer to 50% in 4 years' time. So I'm reasonably hopeful that between 3 and 4 years, the FMCG and the edible oil portfolio should be 50-50. And to the second question, our application for the shareholders' approval is already there, which we're anticipating that in 3 weeks' time, we should have it with us. The application for the regulatory approvals have already moved, and we are hoping between 4 and 6 weeks' time, we should have the business pretty much in our fold.
Just before we wrap this up, if you could give us a sense of what could be the contribution from this business in FY25?
So FY25 on a, this, if we get it for the 2 full quarters, for example, I'm estimating that, it depends on how the sort of approval comes in, but we should be able to add a top line of anywhere between 1,200 to 1,300 crores and a margin base of about 18% within this fiscal itself.
All right. Thank you so much for stopping by and giving us all those details. 12 to 1300 crores with 18% sort of margins coming in from the acquired businesses this year. Steady state margins for the consumer business between 11 to 12%, including consumer staples, and around 2 to 4% margins for the edible oil business, with 4% as the base, at least for the next couple of quarters. That's about Patanjali Foods, and we're out of time on this edition of Chartbusters on that note as well. And as we wrap up, let's tell you a quick programming note. At 11:40 a.m. today is a special discussion that we've lined up for you, where we will have gentlemen like Rajesh Baheti, Deepak Shenoy and Jimit Modi joining in on the regulatory red flag that have come by on the sharp surge in F&O volume. The clamour to increase the clampdown on F&O trading has increased. So let's talk about this at 11:40 a.m. on CNBC-TV18.